Heiken Ashi charts are very powerful when combined with the price action analysis. The idea is simple. You look at the emergence of the new trend or for the reversal of already existing ones. In today's video, I will share a trading strategy I've been back testing lately with promising result strategy with this mainly price actions based using Heiken Ashi charts. On the exponential moving average and the rising weight pattern, Heiken Ashi candles essentially capture the price, the place of price. What I like about Heiken Ashi chart is that candles don't change color until the trend change, and as a result, the charts generally have longer runs of green or red candles. There is technically with Heiken Ashi for the candles to stay red during the downtrend and green during the uptrend, whereas normal candlesticks alternate colors. Even if the price is moving nominally in one direction. Another major advance is that Heiken Ashi chart provide much simpler interpretations, as there are not as many patterns as they are with candlestick charts, and our averaging of the opening and close price means that trends are easier to identify. In a sense, Heiken Ashi make trends easier to spot and helps traders to remain longer in trade. Each of Heiken Ashi bars start from the middle of the bar before it and not from the level where the previous candles has closed. This is the major factor between the standard and Heiken Ashi candlesticks patterns, and this is important to know because in this way you filter noise, foreshadow reversal, and identify the more easily classic chart pattern. There are 5 primary signals that identify trends and trade opportunities. Green candlesticks signified and uptrend. Green candles with no lower shadows indicate a strong uptrend. Candles with a small body surrounded by upper and lower shadows indicates a trend change. Red candles indicates the downtrend. Red candles with no higher shadows identify a strong downtrend. The second component of the strategy is that rising weight. The rising weight is bearish pattern that begin Y at the bottom and contrasts as the price moves higher and the trading range narrows, while the rising weight is mainly a reversal pattern. These formations can also fit into the communications category as the continuations pattern. The rising weights will still slope up, but the slope will be against previous downtrend. As the reversal pattern, the rising weights will slope up and with the previous uptrend, regardless of the type, reversal or the continuations, rising weights are bearish. The rising wedge can be one of the most difficult patterns to accurately recognize and trade. While it is consolidation formations, the loss of upside momentum on each success high gives the pattern its bearish bias. However, the series of the high highs and higher lows keeps the trend mainly bullish. What we need to identify is the final break of support, also the rising weight chart pattern from when price consolidates between two converging support and resistance lines. In this case, the support and resistance lines both have the point in the upwards directions, and the support line has to be steeper than the resistance lines. The third component of our strategy is exponential moving average, mainly to confirm the weight breakout that we indeed to trade. We will use an exponential moving average because it exhibits a lower lag than the simple moving average, which makes it better for identifying how to place behavior may be changing. The choice of moving average length is largely depending on the time frames you're analyzing and your trading styles. The 50 EMA or the 100 EMA are good potential average you could use with the additional of the exponential moving average. You basically analyze price crossovers. When you identify a wedge breakout, you want to see price moving below the EMA to confirm the momentum shift to the downside. The full strategy involves finding a rising weight pattern on the Heiken Ashi chart and trades after price breaks the pattern below the exponential moving average. Here are 10 main aspects of this strategy. First, Heiken Ashi filters out market noise and to reduce small corrective, making the signals more transparent. The smooth effects make it easier to find out rising weight patterns. Second, prior trend. In order to qualify it is as a reversal pattern, there must be the prior trend to reverse. Sometimes the current trend is contained within the rising weights. Other times the pattern will form after the extended advance. Third, upper right resistance line. It takes at least two reactions highs to form the upper resistance lines, ideally three. Each reaction high shows be higher than the previous high. Fourth, lower support line. At least two reactions lows are required to form the lower support line. Each reaction low should be higher than the previous lows. Fifth, contractions. The upper resistance lines and the lower support line converge as the pattern forms. The advantage from the reactions lows lower support line become shorter and shorter, which makes the realize unconvincing. This chart and upper resistance lines that fails to keep pace with the slope of the lower support line. 6. Supports break bearish confirmations of the pattern does not come until the support line is broken in the convincing fashion. As I said earlier, the breakout is the signals we will use as our entry signals. Once support is broken, there can sometimes be reactions really to test the near fault resistance levels. 7. Volume. Ideally, volume will decline as the price rises and the wedge evolves. On expansions of volume and the support line breakouts can be taken as the bearish confirmation signals. 8. EMA breakouts. After the market breaks down through the lower support line, it should also break below the EMA and ideally should remain below it. 9. Profit target. Usually you should aim to have a risk-reward ratio over the 2 or more rising weights are safe to have the price target that's equal to the distance of the weight. You measure the distance of the weight and you project the distance of the breakout point. 10. Stop loss. Generally, you should place a stop loss to give the market some room to move. False breakouts are quite common, and by giving the market some extra room to play with, we may avoid some of these. The high of the weight is a good start for the initial stop loss, which could be moved as the market makes lower slows. Here's an example of the rising weights we found on the Heiken Ashi chart. We have the prior uptrend, the upper resistance line and the lower support line converge as the weight pattern formed. The slope of the lower support and steeper than that to the upper resistance lines. Less slope in the upper resistance lines indicates that momentum is weakening as the price makes new highs. The price tested the support line before finally breaking with the sharp decline. The previous reactions lows was broken after this Heiken Ashi candlesticks. Volume decreased before the support line was broken, and there was an expansion of volume after the breakout, which is a good sign that the market has shifted to the downside, entry below the breakout point with the price target that's equal to the width distance of the weight and the stop loss above the height of the wedge. Another effective confirmation is the bearish divergence on the momentum indicator. The rise weight pattern on the uptrend signals exhaust of the momentum. You can confirm this exhaustion in the other way when the technical indicator will disagree or fight with the actual price actions. Divergence appears when the technical indicators like RSI, MACD, stochastics begins to establish a trend that disagrees with actual price movement. The disagreement or divergence between bullish price actions, high heights, and the trend of the oscillator lower heights is another clue that market could go down. If the previous examples we trade the setup as the bearish reversal patterns, we can also trade it as the bearish continuation pattern. In this case, the price came from the downtrend before consolidations and forming high highs and even higher lows. As the continuation patterns, the rising weights will still slope, but the slope will be against the prevailing downtrend. During the formations of the rising wedge during a downtrend, they are the same tools that can be used to determine whether the pattern is worth trading. The pattern, for instance, a line formed with the minimum to six level higher peaks. The lower support line formed with the minimum 6 higher lows. Price continuations with the slope of the lower support line as proof that of the upper instance line of the volume declining as the price was rising, and increase of volume after the support. Upper instance lines is the volume decrease the price was rising, and increase of the volume after the support line breakout. And additionally, you could look for the divergence on the momentum oscillator. There are many false patterns or the patterns in this side that may come off as the rising wedge. That's why we are using Heiken Ashi charts instead of the traditional candlesticks to eliminate noise on the chart and keep the dominant trend is in display. In addition, the other way to determine the true rising wedge from the false one is by the final price volume divergence. When the breakdown does happen, you have the green light is going to short. There is several examples of the very trade. As always, if you learn something new and fun valuable, like to show your support, subscribe to our channel and click the bell icon to stay notified when we upload next video. Until next time.